Let's take a quick walkthrough on our economic value added. Our economic value added is our after-tax divisional income minus our total annual cost of capital once we've adjusted them for certain GAAP-based conventions such as the expensing of research and development cost and expensing R&D. Because remember, we only spend money on R&D and advertising because we expect to have a future economic benefit. So in reality, we should view advertising as an asset and R&D as an asset. We should record both of those as assets on our balance sheet and then amortize the cost over time. From the perspective of our accounting equation, this is what it would look like when we capitalize advertising and amortize the cost over time. If instead of recording an expense, we recorded advertising as an asset, we would have higher assets. We would have lower expenses in the current period, which would make our current period net income higher, which then, of course, makes our retained earnings go up and keeps our balance sheet in balance. Now, in future periods, we will amortize the advertising cost just like we do depreciation expense, and we will record an annual expense as we amortize that cost. Let's go ahead now and take a look at the example that's given in Exhibit 14.9 on page 542, or 541 rather, of the textbook. We're going to take a look only at the Western Division, and we're given information for year 1 of the Western Division. That's very important. So that's the current year, and year 0 is last year. So here we have year 1. We had after-tax income of $336, and we are going to assume we had year 1 advertising expenses of $1,200. So from an adjustment perspective, we need to add back that advertising expense that we incurred this year to net income. So we will treat that as a cost capitalized asset rather than expense. So we take this year's net income and add back this year's advertising costs. Now we need to look at historical advertising expenditures. We are told that the Western Division last year, in year 0, spent $800,000 on advertising, and that we think our advertising will have a 2-year life. So let's go ahead and look at our amortization schedule for our advertising cost and our net book value for our advertising cost. First, let's look at the cost of $800,000 that we spent last year. If we assume it has a 2-year life, then the annual amortization expense will be 800 divided by 2, or $400. Typically, we're going to apply our half-year convention because the assumption is that the advertising wasn't necessarily incurred at the very beginning of the year, but on average throughout the year. So our half-year convention says in the first year we take half of our annual expense, or $200. In the next year, we'll take the full $400. And then in the third year, we'll take the remaining half year of depreciation or amortization expense. So at any particular time, here's our net book value for our advertising cost for year 0. It cost us $200. First year we had $200 in amortization expense. That gives us a time 0 end of year net book value of $600. Our net book value at the end of year 1 will be $200, and that's again $600 minus an additional $400 in expense. And then finally, after the full 3-year period, we will have nothing left for advertising expense on our books. In year 1, the current year, we are spending $1,200 on advertising expense. And again, that's a given. That's the amount we've added back to current year's net income. If we assume a 2-year life, the annual expense will be $600. In the first year, we will take, following the half-year convention, $300 in expense. In the next year, we'll take the full $600, and in the final year, the remaining half-year worth of expense. So let's go ahead now, and again, we're focusing on the current year, year 1. This year's amortization expense then will be the $400 from the year 0 or time 0 expenditures, and $300 for this year's amortization expense on this year's advertising. So on a combined basis, our total amortization expense for this year will be $400 plus $300, or $700. So to calculate our adjusted net income for this year, we added back the current year advertising expense, and now we've deducted the amortization expense on the advertising expenditures that we have capitalized in year 0 and in year 1, the 700. So 1,500 minus 700 gives us our adjusted net income of $836. Next, we want to look at our divisional investments of $1,500. Recall from our accounting equation, assets equal liabilities plus equity. We're concerned with the investment. What have investors provided us in terms of capital funds? Since assets equal liabilities plus equity, and again, we're concerned with the liability and equity side, we can use liabilities and equity, or we can use assets since both are equal. We're going to use assets and then add back current liabilities. Remember, those were the free financing provided by investors. We get this information from Exhibit 4.3. Here's our total assets, 1,500, and our current liabilities are 352. So the net funds provided by shareholders and debt holders, it just so happens to be only shareholders in this case, is the $1,148. And we can see that here on our PowerPoint slide, the investment, net investment, $1,148. Now we have to add back the unamortized portion of our advertising expenditures. Going back to our Excel worksheet. And again, by convention, in this book, our authors use beginning of the year assets. At the beginning of the year, which would have been the end of year 0 or our base year, we had not yet purchased or spent money, the $1,200 on year 1 advertising, but we had spent $800 in time 0. Since we'd amortized 200, the remaining net book value was 600. So this will be our adjustment to our investment base. If for some reason instead we were using end of year asset values, we would have used the 200 plus the 900 for a total of 1,100. But we're using beginning of year assets for our unamortized advertising costs. So we're going to pick up what's there on a combined basis, beginning of the year, net book value, 600. So 1,148 plus 600 gives us an adjusted divisional assets of $1,748. If we require a 20% return on our adjusted divisional investment, the 1,748 times 20%, we're going to require a return of $349. Our adjusted divisional income was 836. 836 is greater than our cost of adjusted divisional investment return of $349, the difference being $486. That is our economic value added. With our assets, we've earned more return than our investors would have required.